Hi everyone, this is AJ speaking. Today I'm making a video that is slightly different to what I typically post. Today I'm reacting to this X post. The reason why I'm reacting to this X post is primarily because this is a huge account on X, over 600,000 followers in the area where I'm active investing. And the reason why I'm talking about this today is that this huge account is spreading a lot of complete nonsense to its following. And I will explain in detail why. So first of all, he starts with engagement farming opener. The PE ratio sucks in capitalized letters. Then he makes a bunch of other untrue remarks. It's a flawed metric that deceives investors, he says. Doesn't mention that people like Warren Buffett have used this metric all their life. I talked about it tons of times. Charlie Munger. Literally all of the great investors have been using PE ratios for all their career. It's by no means a perfect ratio because a perfect ratio doesn't exist. And every professional investor who was trained in valuation methodologies knows the shortcoming, but also understands the strength. And I will talk about both in this video. But let's carry on in this account's post. And he also says, here's exactly why the PE ratio can be incredibly capitalized, misleading, and what to use instead. I find this crazy because his entire post is like what I find incredibly misleading, but he accuses the PE ratio to be misleading. And the main problem of his post, and I will say this right up front, is that he makes something a problem that does not exist amongst professional investors. So Brian talks about GAAP earnings. So GAAP stands for GAAP, Generally Accepted Accounting Principles, which was not built to be the basis for valuation. And that's why referring to the metrics that you can find in GAAP and calling them misleading is fundamentally stupid, because GAAP was not made for valuation. GAAP was developed to provide a up-to-date picture of the financial state of a company. But valuation is a different thing. And for this reason, every analyst learns to adjust GAAP metrics to make them usable for valuation work. But let's talk about all these points of critiques he makes that actually don't exist among professional investors. So cyclical demand, he talks about, affects revenue. He talks about unsustainable trend affecting revenue. He talks about industry dynamics affecting revenue. He talks about windfall, I suppose revenue that affects revenue line, disruption. Then he talks about accrual accounting. I'll explain in a moment what it is. He talks about business growth cycle affecting gross profit or cost. And then artificially low net income, artificially high net income or earnings per share. So then he goes on in his thread and he talks about the PE ratio's flaw is that the earnings can be misleading. But again, the GAAP earnings, the earnings he's talking about, they are not meant for valuation. And it's true, and that's why I always say do not use GAAP earnings, because depending on the company, the type of industry, and various other factors, GAAP earnings are completely unusable. And I give you one example, or maybe another one too. Tesla, for example, when Tesla recognized Elon's comp package, Tesla recognized several $100 million in share-based compensation for Elon. That created a situation in which Tesla reported actually quite good quarters, but on a GAAP basis was loss-making, or earnings were super depressed by these temporary large accounting charges. And for that exact reason, Tesla provides investors with what's called a non-GAAP number, or non-GAAP or adjusted number is usually synonymous. They mean the same. And what Tesla did, they adjusted for these large outflows, accounting charges, and gave you an adjusted number, a non-GAAP number that is more representative of the ongoing earnings power of the company. And the great thing about valuation is you do not have to take my word for it. You can test this yourself. And the way to test any multiple, not only the PE multiple, but any multiple you can think of, and the quality of the multiple is determined by one thing and one thing only: the stability of the multiple. If you have a multiple that fluctuates from 0.5 times to 600 times, jumps up and down all the time, is completely unusable. So let's think about what would be the ideal multiple. The ideal multiple would be one that would always be constant, because if that multiple existed based on whatever metric that is, as long as you can forecast that elusive imaginary metric, you could forecast with precision the share price. However, it does not exist. So you try to find the multiple that is the most stable you can find. That's the ultimate quality measure of any multiple. But this requires an enormous amount of work to work out, because depending on the company, the industry, etc., this all slightly varies. So that's why most investors, they use certain types of shortcuts, and it turned out that the PE multiple, the adjusted PE multiple in many industries, in many companies, is the most stable multiple you can find. However, depending on where we are in the equity market cycle, this can vary still a huge amount. And the multiple also changes over time. Typically, when companies are quite small or young, whatever, they tend to have more volatile multiples. And as they grow larger and there's greater understanding in the larger investment community about a stock, then the multiple starts to narrow in a range. For example, NVIDIA is a perfect example. NVIDIA, my subscribers notice, because I show my subscribers the multiple trends, used to have extremely high volatility in the multiple, but over the last few years, the multiple significantly narrowed, and for several months now, the multiple has reduced into a very narrow range by tech stock standards of around 25 to 35 times. The other issue with Brian's PE discussion is he doesn't really talk about what PE is talking about. There are different kinds of PEs, and but we should understand when he talks about PE, he talks about the forward PE. The forward PE is defined as the price to earnings ratio based on earnings of the next 4 unreported quarters. That is the Wall Street standard. So when bankers or investors talk with each other, they talk about PE ratios, and they don't say anything else. They don't qualify the metric. They always mean the forward PE. However, there are other PE ratios. For example, in a stock that is very backloaded, for example, a stock like Tesla that has maybe a few rough quarters ahead, a smart way to do it is to look at the next 24 months metric. That next 24 months metric doesn't mean you take the earnings of the next 24 months. No, you take the 4 unreported quarters after 4 quarters. Because a PE ratio is always based on an earnings metric that spans across 4 quarters. It's an annual number. But you can choose whether you look at the next 4 quarters or after a year at those quarters. Technically, you could also define one that starts after 6 months. But this is very uncommon, and this is a more advanced topic for probably most investors, but this can also give you more insight. Again, the principle is that the multiple you pick should be the one that is the most stable. So let's talk specifically about some of the points he's raising. He's talking about accrual accounting. So first of all, he doesn't even explain what accrual accounting is. He just says the GAAP income statement uses accrual accounting. Accrual accounting is useful, but it's basically an accountant's opinion. No, it's not accountant's opinion. There's very clear principles how you're supposed to do accrual accounting, and there are auditors that will check that you did it correct, that your in-house accountants did it correctly. So what is accrual accounting? Accrual accounting simply records revenue and expenses when they are earned or incurred, regardless of when the actual cash payment is received or made. Okay, so that's the basis. And all modern accounting systems, not only US GAAP, but also IFRS, which is mostly used in Europe and also in Japan, they all use accrual accounting because it makes complete sense once you think about it, from the perspective of the purpose of financial statements, which were designed to provide information to investors, but were not designed for valuation work. And that's why I always stress in my work that it's so important to look at free cash flow, because free cash flow is another metric that you can use that adjusts for all the effects that are caused by accrual accounting. But let's go back to his post, and then he talks about some of the effects of accrual accounting. He lists accounts receivables, accounts payables, amortization, asset impairment, deferred revenue, depreciation, inventory, and stock-based compensation. So Brian just throws these terms at his readers, but doesn't explain any of them. and doesn't explain why the income statement would be a complete mess and would be completely unusable to most investors, except some mathematical geniuses, if we didn't apply accrual accounting. So let's make some example. Let's say you have a company that has some quarterly cyclicality or seasonality in the numbers. This is basically for all companies that are affected by, for example, strong fourth quarter business due to Christmas and other things. For example, Apple is such a company. Apple has always a huge spike in revenue in the fourth quarter because a lot of people give iPhones and other Apple gadgets as presents. So what these companies often do, they pre-produce a product because they anticipate a huge spike in a certain time period. This pre-production makes a lot of sense where it's possible, and in some companies they pre-produce for certain peak periods, even 6 or sometimes 9 months ahead of time. And this makes complete sense because it then maximizes capacity utilization. Otherwise, if you didn't do that, you would have to build capacity that can then cater to this peak capacity that only happens during a short period of time. But here's the problem. Without accrual accounting, all this pre-production would be recognized in expenses. So what would happen is, let's say you're still in Q3 before you get all the revenue from this peak fourth quarter, but you would already recognize all the expense for this pre-production in the third quarter without accrual accounting. So what would happen is that, let's say you have typically a gross margin of, making things up, 20%. Your gross margin might drop to 5%. Your gross profit would drop to almost nothing. But your operating expense basis would be fairly stable. This means you would then potentially report a loss in Q3, even though Q3 was totally normal, you were profitable, but because you pre-produced for the fourth quarter, you were on paper loss making. And then of course you would have the complete unwind, so the reversal of all of that in the fourth quarter, where you recognize where you generate the revenue from all the pre-production, but you wouldn't recognize any expense from all the product that you generated already in Q3. And then you would have a huge spike in revenue, a massive drop in expenses. You would then have a gross margin of, and would jump to whatever 40%, you would have a huge increase in gross profits, and so you would have this enormous volatility in your income statement, and this would make it significantly less insightful to most investors. And this goes back to what I said earlier, because all these accounting principles that were designed with what provides the most pertinent information to investors, and all the other items he's listing, amortization, asset impairment, deferred revenue, depreciation, it's all about providing a more, let's call it steady state picture of the company. But as I said earlier, it's not perfect. And that's why you need to look at these things always in conjunction with other things. And I've been pointing this out in my research coverage, especially in the auto industry. Because ultimately what matters, regardless of all this stuff Brian is talking about here, ultimately what matters and what you should be focused in, what's the cash flow of the company, and I'm talking about free cash flow. Because if a company has strong operating cash flow but has enormous reinvestment need to keep that operating cash flow going, the net result of the two might still not be that impressive or not that meaningful and not justify the company's high valuation. For example, in its entire 30-year history, Amazon generated, in quotation marks, only 117 billion in free cash flow. And that's why Amazon in its entire history has only done 7.8 billion in share buybacks. This is an extreme outlier amongst the Mag 6. The Mag 6 comprises Nvidia, Microsoft, Apple, Alphabet, aka Google, Meta, aka Facebook, and Amazon. But let's go on in Brian's thread. Here he shows, again, he moved on from throwing these terms at his followers, and he didn't explain any of them. But before we move on, I will just go quickly through them. So accounts receivables is when third parties owe something to the company. If the amount that is owed to the company goes up, this is cash flow negative, because it effectively means you recognized something for which you have not yet received the cash. And in the cash flow statement, you adjust for that. So an increase in accounts receivable, so the amount that is owed to you, when it goes up, is negative. The same is true when accounts receivables goes down, is cash flow positive, because it means that people who owed something to you then paid you. The exact opposite is accounts payables. This is when you owe something to someone. A typical case is suppliers. For example, in the auto industry, if I sell a vehicle for which I have not paid for the components and materials of my suppliers, my accounts payables goes up, but it's a cash positive if I sold the product. Because if I sold the product, I recognize the revenue and the expense. So it's reflected in my earnings, but because I haven't paid my supplier yet, that expense that I recognized in my earnings is reversed out. And that's why it's a cash positive in my cash flow statement if the accounts payables go up. But then again, if I pay my suppliers and reduce the accounts payable amount, it's a cash flow negative. Then amortization. So amortization is a process where you spread out the cost that you incurred at one point in time over many periods. The most common type of amortization is the amortization of intangible assets. There are all kinds of intangible assets. It can be capitalized client relationships or access to distribution channels in certain industries, for example, the insurance industry. And because these things are not tangible, that's why they're called intangible assets. And if they're thought of as having a finite useful life, you amortize them over time. Another one would be R&D expenses. Under certain accounting regimes, under US GAAP, most R&D spend is expensed as incurred. But under IFRS, a lot of companies, they capitalize, i.e. they spread over many periods R&D spend ahead in a certain period. But here again, let's say a company works on a huge product, has a huge R&D push, or acquires another company and gets like access to certain distribution channels at certain value, there would be a huge upfront cost. And amortization is a concept that just smooths out these effects and therefore makes the income statement more meaningful to the, let's call it, non-expert user. Because the problem is, even an expert user who understands all these things in detail, without all these effects of accrual accounting, every time a company reports, you literally would have to take all these numbers and you would have to make tons and tons of adjustments to get to an underlying view of the company. And to eliminate this enormous inefficiency that would exist in global financial markets, the accounting standard setting board makes up these principles. So there's a very robust basis, and this has nothing to do with misleading investors, etc. This is just to provide a useful basis for investors to on which to start their work. But Brian takes these concepts which have been developed over, at this point, generations, and throws them out of the window and makes them as if it was a huge problem. No, it's not. Let's move on to the next item. So asset impairments. Asset impairment is simply you had an asset and you realized, or you were forced to realize, oh, it's not worth as much as I thought, and then you take a write-off, but you're not paying for it. It's not a cash out, but you record an expense in the income statement. That's why your earnings go down, even though nothing happened. But again, this item would be backed out in the cash flow statement. So then deferred revenue. Deferred revenue is you get revenue for something that you have not yet earned. So you take in the cash, but you do not recognize it in the revenue line. And that's why deferred revenue does not show up in your earnings. It only shows up later as you satisfy your sometimes called performance obligation. Then you release the deferred revenue into your revenue line, and then it flows through the income statement and it's being recognized as earnings. So you can maybe slowly see this accrual accounting has pros and cons for it can inflate and deflate the earnings, so it goes both ways. It's not like accrual accounting is just boosting earnings or something. No, not at all. Again, accrual accounting aims to provide a more underlying view of the business without, or tries to eliminate accounting volatility that is caused by timing effects. Like deferred revenue is just a timing effect. It just happened that you got all the revenue or payment up front from the customer for something that you deliver over several periods. But because you report in accounting periods, you need to break these payments down. So once you start really thinking about all these items, they make completely sense. Next one up in this list is depreciation. Here, let's take Tesla as an example. When Tesla built Giga Texas, they had cash outflows over a very short period of time, or roughly $5 billion, very large capital expenditure. And according to Brian, this is bad. So according to Brian, Tesla should have recognized 5 billion in 1 or 2 quarters in the income statement. So Tesla would have reported enormous losses. But of course, they would have been silly. So what Tesla did is they capitalized all these assets, this factory. They paid the suppliers, the construction companies, etc. So there was the cash outflow in a handful of quarters. But then instead of recognizing all this huge expense in a few quarters, Tesla, just like every other company in the United States and pretty much the rest of the world, then spread out this cost of this huge capital investments from which they extract benefits for many years, and in terms of, for example, property in sometimes decades, and just recognize a little piece every quarter of that cost. For example, if this was depreciation was so bad, for example, when Tesla built this huge AI supercluster, Tesla would have been massively loss-making that quarter, but no, because thankfully we have accrual accounting, and pro investors understand how it works, or frankly everyone who studied first to second semester accounting. Now, this is like very common business practice. You have a huge capital investment, you capitalize it, and then you write it off over many years. So next, inventory. We can go back to the example I used earlier. We have a company that might pre-produce. In the auto industry, this is very common. Depending on the distribution setup of a company, they tend to have a certain amount of pre-production at certain points in the year, but it's not a big problem because companies, thanks to accrual accounting, they match revenue and expenses, so they can pre-produce and increase inventory without hurting the income statement metrics. However, in the cash flow statement, for example, if an auto company generates a lot of inventory, it is cash flow negative because the company had to pay for that inventory, i.e. for making the cars, etc. And then lastly, he talks about stock-based compensation. So stock-based compensation is very common, especially in the United States, where a lot of employees, sometimes all the way down to entry-level jobs, get part of their compensation in the company's stock. Stock-based compensation typically sits all across the income statement. It sits in cost of goods sold, R&D, general and administrative expenses, selling and marketing, because people who work in all these areas, and they typically have some element of stock-based compensation. Typically, it's the highest in R&D focused areas. And what the company does, it issues stock to the employee. So it recognizes an expense in the income statement. So this lowers earnings. But because there is no cash out, it reverses that expense in the cash flow statement. And that the other big problem I have with Brian Post, he focuses his readers just on this one-dimensional view. Okay, there's just earnings number. No, this is why we have 3 primary statements, which is the income statement, the cash flow statement, and the balance sheet. And you should always look at the 3 of them. And so the main thing that bugs me about his post is that he really tries to keep his readers stupid, but by focusing them on a thing that is not a thing amongst pros. And my account is all about leveling the playing field for retail investors. And that's why this really bugs me. So next, let's look at what he's using further in his thread. So as he talks about Netflix. So Netflix reported 1.9 billion in earnings, but its operating cash flow was negative 2.9 billion. While it was profitable, he says, in quotation marks, on a net income basis, its accrual cash outflow was enormous. The PE ratio doesn't reflect this at all. And then here's this little snapshot of and you can see by the formatting, he just clipped the SEC filing. And then he points out net income earnings here, first line, and then the last line, cash flow. Well, actually not really cash flow, it's just operating cash flow. But let's not split hair here. But let's walk through what actually happened. So you can already see the by far biggest negative item was the first line item, which is additions to content assets. So because Netflix produces, of course, a lot of content, shows, etc. A simple way of this is like Tesla building a car factory or a bot factory. This addition to content assets will generate, in Netflix case, earnings for not just that one quarter. This will generate earnings for likely many quarters or maybe years. Most likely several years, in fact. So that's an investment in keeping the business going, just like Tesla invests in factories, in tooling, equipment, things like that. Then the other thing he's not pointing out, the second by far largest item, is amortization of content assets. And as we just discussed, amortization is a charge that you recognize in the income statement, i.e. has been taken out of your revenue, so is reflected in the net income, but for which there was no cash outflow, because the cash outflow was probably many quarters ago. So in other words, this additions to content assets, when you pay for it, is here recognized as a big negative, but is not fully recognized in the net income. Only that quarter's amortization is recognized. And then over time, all the amortizations from all the additions to content assets from all prior quarters that are still not fully amortized to zero, they then show up here in amortization of content assets, because you expense them, you've reflected them in the income statement, but there was no cash payment. And that's why here in the cash flow statement, you add them back. So, and you can see very quickly, should Netflix choose to reduce its investments in creating more and more content, they could become very quickly quite operationally cash flow positive. But again, this is not analysis. This video is not about analyzing Netflix. That would be a whole separate video. I'm just talking about the absurdity of the thread and how misleading it is. And then let's move on. So there's stock-based compensation. You can see there's a positive 405 million. So here add back, of course, because again, there's no cash outflow for the company against it, but it was recognized as expense and therefore reflected in net income. And then frankly, the rest is not that exciting and also not that needle moving, because there are a lot of plus and minuses, which mostly set each other off. And this is how you get to a negative operating cash flow of the 2.9 billion Brian mentioned. But again, this is due because there's this huge investment in content. The other important thing you should notice here, Brian actually shows us the cash flow statement from 2019. Last I checked, it's 2025 right now. So why is he showing us a 6-year-old cash flow statement? So this is actually the statement where he took the screenshot from. Sorry, that's the one. So you can see 2019 net cash used in operating activities, the 2.9 billion that he shows us. And also in the prior years, 2018, 2017, Netflix was also operating cash flow negative, 2.7 billion and 1.8 billion. But the important information that Brian denies you is that here, when you look at the latest full year Netflix cash flow statement, the one for 2024, the company generated, drumroll, 7.4 billion in positive free cash flow. And in the prior year, 2023, it generated positive 7.3 billion in operating cash flow. And then in 2022 was 2 billion. So this business invested in the business, is added content, so it built for huge growth, and it paid off. And that's why Netflix was a super investment for any investor over this period. And this also shows you that he's really misleading investors. For example, you could have made the exact same thread or post about Amazon, and you would not have invested in Amazon, because Amazon also invested enormous amounts of capital to build market dominance, and then to reap the fruits of that effort later. So I find it crazy that over 600,000 people follow that account. It's incredible. Even though the information is really low quality and highly misleading, so I can only recommend best is you block that account and similar accounts like that, because that will ensure to keep you poor. Then next he talks about equity investments. This is something, for example, every analyst knows. If you have equity investments and they go up in value, you can recognize a huge gain. And if they drop in value, you recognize a huge loss. Amazon is a perfect example. Amazon at one point recognized a gain on the Rivian IPO in 2021, fourth quarter from memory, of almost 12 billion. But it's a non-cash gain. And then in the subsequent quarters, Amazon recognized very large losses on equity investment, i.e. a reversal of the gains effectively, because the share price in Rivian quickly dropped. So huge accounting volatility. Absolutely no cash effect, because Amazon did not realize any of its investment, and every analyst would completely adjust for these equity investments, would not take them serious, and also this process is also called a look-through, and therefore would not affect their assessment of the company. But this is the type of stuff Brian keeps going on about, and therefore is misleading his followers. Then in this third post in his thread, he talks about one-time events. Again, every analyst is trained to adjust for one-time effects. For example, Tesla had at the end of 2023 a huge, I think, 6 billion release of tax revaluation. That's non-cash. Nobody care about it. And all analysts just took it out. Nobody takes this stuff in seriously. It's all about whether something generates ongoing cash flow or not. That is the principle. That's why, again, he makes a point about something which is not a point amongst professional investors. Then in the rest of his thread, he takes a certain situation from a Starbucks situation. He talks about unsustainable trends, pulling some rather random examples. Doesn't really talk about what really happened. It would take too long to explain all of this to you. I don't want to make this a very long video. It's already quite long. All I can say, and I think I already demonstrated this without a shadow of a doubt, that this is a complete bullshit thread. And if you want to learn about valuation, I recommend you either prompt Grok on corporate valuation, or you find a good book on corporate valuation. There are tons of books you can read. Here I'm just pulling one up that I find is quite... there's a book ages ago I picked for analysts working for me when they were not satisfied with the materials provided by the company. I pointed them to this book to get them up to speed, because it's written by practitioners. But there are so many ways how you can learn about the proper way to do valuation work. Also, if you follow my research, I occasionally touch on valuation topics and discuss them as part of my research. I don't like to talk about just to the ether about valuation theory. So typically what I do as part of, for example, when I present the investment case, I often then touch on a specific valuation topic. So I connect the theory with a case at hand. So anyways, key takeaways, a lot of these finance accounts on X, even if they have a huge following, it does not mean they provide quality information. In fact, there's a big risk that they fill your mind with a lot of bad concepts, which will leave you forever a bad investor. With that, I hope this was useful. Thanks for listening. Bye.